via email. Kick it over to you
Great.
guys.
Thank you. Good morning, everybody, and welcome to Witham Smith & Brown's PPP loan forgiveness application session. Quick, Witham Smith & Brown is about a 1,200 person firm, top 25 in the country. And I think we've been on the forefront of keeping our clients and others in the loop as to what's happening with this law as it keeps changing. We hear some more things are going to change soon, we think. So, but we'll stick to what came out recently. So next slide, please. So our presenters for today is myself, Frank Boudoulet. I'm a partner in the firm. We have Chris DeMayo, who's a practice leader for technology and emergency growth services. Dan Mayo, who's is a national lead for our federal tax policy, and Matt Walsh, who's also a team leader in this SBA assistance group that we have together. So we'll be presenting the session today. Next slide. We'll start right in. First thing I want to say is there are still money available out there. With the second round of funding, we're hearing that banks still have some money. Not all banks are taking applications, but there are a few. So if you have a need for money and you haven't already applied or you're thinking about it, you might be able to get some more money. So what we want to talk about today is the application that came out on May 15th, which was Friday, probably around 7 o'clock at night. This new application came out. And it kind of broke it into 4 parts. So we finally got our first chance to look at what is going to be required to be submitted to the banks. So remember, you have to go to the lender that gave you the loan and apply for forgiveness. So this application has 4 parts. It has the loan forgiveness calculation form, which is the front page. There's an attachment, which is Schedule A. There's a worksheet, Schedule A, and then there's an optional PPP borrower demographic information form, which goes into different demographics of the business owners that applied for the money. This application includes many borrower favorable rules, and it might increase or could increase the amount that the borrowers get forgiven. The first 2 on the application, the first 2 schedules, the schedule 1 and 2, Schedule A, will be supplied to the bank. Worksheet A is not required to be submitted. Although we've been talking to a lot of banks, they're asking for assistance with this. We've been suggesting that worksheet gets submitted as well. For the businesses out there, you need to prepare that worksheet. We're going to go through what's included in all that, but you need to have it anyway. And there's a lot of information that you need to gather for this calculation. So there's a lot of work on your part. Hopefully at the end, you'll see at the end of our session, we have a list of all the documents that are required. Start with that and start getting that together now, because that's going to be important to have as you move through this 8-week period. Next slide, please. So the general comments here. So it redefined the covered period. CP covered period is 8 weeks beginning on the day the money comes into your bank account. Now, we had some clients get money on a Sunday. So that would be the first day of the 8-week period. It's 56 days periods of time. Now, they did introduce an alternative payroll covered period. And this is just for payroll, and it's more for the convenience of the borrower to align their payroll with the 8 weeks. So depending on when their payroll is, you can move that 8-week period. So for instance, if you got the loan, back please. Okay, back, there you go. So if you got the loan on April 20th, and that's okay, Chris. Chris and I have a lot of fun together. He torments me a lot, so and he's doing that now. Except that you're tormenting about 3,000 people. So the loan received on April 20th. So the first day of the pay period is April 26th. So you can move that 8-week period to start on April 26th to start your 8 weeks. I'm not sure why you would do that. Maybe there's a reason, because what you're going to see in a few minutes is that it's possible, we think, that you might get 9 weeks worth of payroll here and 9 weeks worth of expenses. So next slide, please, Chris. So the application expires on October 31st. So we're thinking that means that since this form expires on October 31st, that you need to submit all of your applications for loan forgiveness by that date. Now, the lender has 60 days to process the application and let the borrower know whether they agree or disagree with the amount of forgiveness. Now, the important thing on the October 31st date and to realize is that if you got your loan in April, you have a 6-month deferral for when your first payment is due. So your first payment will be due in October. So knowing the bank has 60 days to turn around the application, you're probably going to want to have these applications into the bank by August 1st, which will give the bank, 2 months to get through, or 60 days to get through that. I have a client that called me up yesterday and said, well, I think I'm going to wait until October because I get the deferral on the payroll taxes on the Social Security part, the employer's Social Security part deferred. And I told him that, well, on $10 million, your first payment is going to be due in October, and it'll be $550,000 plus interest if you don't get it forgiven. So with that, he said, I'm going to start my application really quick, so I don't have to pay that amount, because they believe they're going to have most of it forgiven. So that's an important thing to think about, is to get these done quickly. Now, on this form, they also have a box on the application to check off that if you, along with your affiliates, including your affiliates, got more than $2 million. So if you had an entity that's owned by the same individual and controlled by the same individual and has 3 different entities, and they got $1 million, $500,000, and $700,000, the total is 2.2. You're going to have to check that box that said you got $2 million. Now, that just enables the SBA to have a nice red flag to say, hey, this is one of those that we might probably want to review at the end. So you got to make sure that you have that box marked off, and that's going to help the SBA. The amount forgiven is tax-free. There is no deduction for the expenses relating to those amounts. Now, that's as of right now. There's a lot of talk right now in Congress about the purpose of this loan was to be a tax-free loan to the business. But therefore, if you don't also get the deduction for the taxes, for the payroll and the other expenses, then it's really not tax-free. It's a wash. And in essence, the borrower will have maybe more taxes to pay because they won't have deductions against the revenue. So this could increase the tax liability if they do not allow those deductions, which right now, as it stands, they don't. Next slide. I think this is Dan, right?
Yep, great. So we're going to turn now to the costs that are eligible for forgiveness and define them a little bit before we get into the more detailed rules. So first, we have the definition of payroll costs, which is in the CARES Act itself, and which is up to $100,000 cash compensation per employee per year. We're going to break that down a little bit on the next slide, talk about that. But it also covers the overhead items, so the interests on mortgage obligations, rent, utilities. On the interest on mortgage obligations, some questions are coming in about this, about does it cover leases of personal property, et cetera. It does if there's a lien placed on the property. When you look at the definition of a covered mortgage, it talks about there being a lien filed on either on the real property or the personal property. So that's an important test when looking at the loans to see if it's a covered mortgage obligation. On the utility side, there is a defined list of utilities: electric, gas, water, transportation, telephone, and internet. The questions we get on this usually center around, is it can it be landline, cell phones? We think they're both covered. And also, what is transportation? We put here, there's an example that in one of the interim final rules published by the SBA, where they talk about gas on a leased automobile. So gas, oil, these kinds of things would go into the transportation expense. And one of the more favorable things the application does is the definition of paid and incurred expenses. It takes a disjunctive approach. So it's either expenses that are paid or incurred during the covered period, which is a very favorable rule. If it were paid and incurred, it would be a much more limiting rule. So what it covers then is it covers payments for payroll and also non-payroll, but that are incurred before the covered period, or that's the alternative covered period as well, alternative payroll covered period. So if it's incurred during the covered period, before the covered period, but paid during the covered period, and also on the back end of the 8-week period, you have expenses that are incurred at the back end of the 8-week period, but are not paid until after the conclusion of the 8-week period. So those would be included as well. So it is very favorable. It does look like it allows for, clearly allows for more than 8 weeks of pay for employees, of course, subject to the cap of the 15,385, which is the 52 weeks, I'm sorry, 8 weeks worth of compensation. But it does seem to provide an asymmetrical rule on in terms of what can be included before the 8-week period and what can be included after the 8-week period. Although the rule is open-ended, we are advising people to proceed cautiously with the amount of expenses that have accrued before the 8-week period that they're trying to lump in there. And we do certainly recommend disclosure if there's going to be a significant item that accrued before the 8-week period that's paid during the 8-week period. On the limitation side, the loan forgiveness amount cannot exceed the principal amount of the loan plus accrued interest. The application is a little vague on this when it talks about the loan amount without covering the accrued interest, but that they have stated that in the past, so we think that will be covered. Next slide, please. The definition of payroll costs. This is an interesting one. So we're all familiar by this point with the statute. The SBA seems to have reversed course on the salary cap and what it applies to. And so when the application first came out, there was a borrower fact sheet where the SBA clearly showed that the salary cap, the cap of $100,000 per year applied to the salary and wages, but it did not apply to the vacation, parental, family, medical leave, and also did not apply to the dismissal and separation payments. So that was crystal clear the way they showed how the cap, which it applied to. Over time, they then started switching to this concept of cash compensation. And when they switched to cash compensation, it didn't really trigger any alarm bells because that was still consistent with the way they had previously defined it. It wasn't inconsistent yet. But when they published this application, they now have made the full 180-degree turn away from that borrower fact sheet and are now of the view that the salary cap applies to all of these cash items. So it applies to the salary, wages, tips, all the vacation, parental, family, medical, sick leave, and also dismissal, separation payments, which is, you can think of as severance. So all those payments now are subject to the cap of $100,000 per year. That may be a surprise to people who are of a different view based upon explicit and clear prior guidance from the SBA. In payroll also includes those other items which everyone is now familiar with: the contributions for group health care benefits, the retirement plans, contributions to employment plans, and then also state and local payroll taxes imposed on the employer. The guidance that the application provided is that it does exclude pre-tax and after-tax employee contribution amounts. So I don't think most people thought this was included anyway, but they did make it explicit in the application. On the general partner side, they made it clear in prior guidance that it's the K1 box 14A, the net earnings from self-employment. That's the number you use. You multiply it by 0.9235, and that's the reason they shrink it by that. It's to reduce the employer's share of self-employment tax. And it is limited on partners to the lesser of, and the application doesn't state it this way, but we're shorthanding the rule. The lesser of 8 weeks worth of 2019 compensation or 15,385. And this is similar. The same rule here applies in the next bullet, where they will lump them all together, where they define the rule. And so this is owner employees, self-employed, and general partners are all limited to the lesser of 8 weeks worth of 2019 comp or that maximum of 15,385. And so what we think they were trying to get at here was they didn't want the owners to provide, and self-employed people, partners to provide, who are generally owners of the business, to provide themselves with a larger compensation amount this year. For instance, if they were making 70,000 last year, they didn't want them to bump themselves up to 100,000 to use up a lot of the money, PPP money, on their own compensation, as opposed to compensation for employees, payroll for employees. So we think that's the reason for the 2019 limitation. But what does this suggest? It does suggest they are limiting that to 2019 amounts just for these 3 classes of people. This implies then that hazard pay and bonus pay in excess of 2019 can be paid to employees. So there is a helpful inference to be drawn here from the way they phrase this about the limitation that applies to the owner employees, self-employed, and GPs. On the independent contractor side and sole proprietor side, nothing's changed here. It includes the net earnings from self-employment. Again, that's Schedule C, line 31. Even if it's not filed with the IRS, you have to prepare it and submit it along with the application documentation rules. Next slide, please. So we have an example here of what's the expenses that are included in the covered period, and we want to show how the 8 weeks can be expanded given that it's paid or incurred. So you look at the facts here on the left. The company here has a bi-weekly payroll period, so every other week. The loan was received on April 20th, so the 8-week covered period ends on June 14th. So it's a 56-day period. This was also the same dates that were used in the PPP loan application when they used examples. So the first payroll period, as you see, started before the covered period and ended after the beginning of the covered period, and then it's paid on April 24th. So even though there's 2 weeks in that pay period, 1 week preceded the covered period. Then we have going down that last column on the right, the next pay cycles are 2 weeks each, and then that final pay cycle there, 6/8 to 6/19 of 2020. Chris, I think you just have to hit remind me later there. Thanks. It's funny, no matter how many things we go ahead.
Probably a bad idea for me to do an update at this moment in time, I imagine.
Right. It's funny, how many things we shut off. We plan for everything. You can't plan for all these things, and your computer had its own mind of its own here. So in this last one here, 6/8 to 6/19, you see that this pay period ends after the covered period. So 1 week, and it would be paid on June 19th, which is again after the 8-week covered period. So 1 week would be included here. That last week was incurred through the end of the covered period would be included. So when you add it up, there's in this example, and it can be done so there's more weeks put in here. This example here shows that you can get 9 weeks of payroll included in the 8-week covered period by virtue of the fact that they have the paid or incurred definition. Again, this could be expanded to more than 9 weeks depending on how you phrase the example, but we just used it here to come up with 9. Next slide, please. So this another example here with the paid or incurred rule, but also showing some of the limitations. So this is a company with 2 owners and 2 employees. And so we look at the first employee 1 going across from left to right. We see the pay during each of the pay periods. The last period, the reason we have less is because only 1 week was during the covered period, and this was paid after the covered period, but only 1 week's included because it was incurred. So the total comp was $17,308, but this employee is limited to $15,385 because that's the $100,000 limitation. So they're limited here. Employee 2 was received, and we're going to look at that second column from the right. So that employee number 2 received $13,500, no limitation on the allowable payroll costs. The owner employee now receives compensation of $17,308, but they're limited by the $100,000 limitation, so they're limited to $15,385. This last owner is limited not by you see they made $52,000 last year, but they're making more this year. So even though they made $13,500, they're limited to the 2019 compensation, which limits them to $8,000. So we wanted to show a couple of these examples in practice, how you need to look at different employees versus owner employees are different. There's a limitation of the $100,000 plus the 2019 compensation, which can be a limiting factor here. So we'll go to the next slide. Thanks. And so now we turn to non-payroll costs. The application is the same favorable payroll paid or incurred rule for payroll costs. And by payroll, we're talking about, again, the interest on mortgages, rent, and utilities. It does maintain the 25% rule. So non-payroll costs or the overhead cannot exceed 25% of the total forgiveness amount. And the way the application does this on the calculation page, it applies that 25% limit to the gross spending on payroll costs before any other reductions. So it takes the number of, I think it's line 1 of payroll costs, and that's what it brings down to the bottom and multiply it by 75% to make by 25%. So let's give an example here of how the rule works in practice. You have a loan amount of $1 million. The spending on eligible payroll costs is $600,000, and the spending on the non-payroll costs is $400,000. So how do we calculate the limit? We take the payroll costs and divide it by 75%. So 600,000 by 75% gives us 800,000 of a total loan forgiveness amount. So then we take the 800,000, subtract out the payroll costs, and that allows for 200,000 of eligible non-payroll expenses. So right now we see that even though they spent 400,000 on overhead or non-payroll costs, only 200,000 of that will be eligible for forgiveness. So yeah, on that last bullet there, we show 200 is eligible for forgiveness, and 200,000 of those costs are not forgivable and needs to be repaid to the lender. So in this case, this is a true cost to the borrower because they spent $1 million. They're going to receive forgiveness of 800,000 and have to now repay the bank $200,000. So we refer to that as a cost to the borrower because their total spending with regard to this will be $1.2 million. So with that, I'll turn it over to Matt to cover the next slide. No, I think this is me. Sorry, Matt. This is me. Yeah, this is still me. I got confused where we were. So this is the forgiveness calculation. This is just the mathematics of how it works in a simplified format. So this is done on the application. As Frank mentioned, there's a calculation page, there's Schedule A. There's also the Schedule A worksheet, which is not submitted to the lender. And what the calculation does at a high level is it adds the payroll costs and the non-payroll costs that we just saw on the prior slide. Then you reduce it for the wage reductions first. And this is important because this is how they prevent the double application of the headcount reduction and the wage reduction rule. And so there was a concern in the that if there was an employee was included in the reference period but not in the covered period, that there's an FTE reduction, so there'd be a headcount reduction. There's also concern that they would consider that a wage reduction, since that employee went from 100% of their pay in the reference period to 0 in the covered period. So there was a concern that a literal reading of the statute would apply both of those rules to the same employee. And thankfully, they've come out and fixed that. And the way they did it was by doing the wage reduction first, and then they do the headcount reduction second and arrive at a potential forgiveness amount. It's almost like a tentative amount. Then the final forgiveness amount is the lesser of 3 things: either the potential forgiveness amount, the PPP loan amount, which again, we think this should be loan amount plus accrued interest, and then payroll costs divided by 75%. That's what I mentioned on the previous page, was the gross spending divided by 75%. And then finally, the application here, before we turn it over to Matt, they made it clear that there's no cliff effect to the 75% spending amount. So there was some concern among people that if a borrower did not spend 75% of the loan amount on payroll costs, there was a concern that they would get no forgiveness because they didn't spend the loan appropriately. And thankfully, that's not the case. There's it's like a pro rata approach. So the borrower will receive forgiveness for what they spend, assuming there are no reductions. And even if they fail to spend the 75% of the loan amount on payroll costs, they can still achieve forgiveness for what they did spend, subject to the other limitations of the 25% of overhead, and then subject to the other reductions. So that's how the calculation works in a big picture. Turn it over to Matt now to get into the detail on the wage reductions, headcount reductions.
Thanks, Dan. Hope everyone's doing well. So the wage reduction rule, as Dan mentioned, is now recategorized as sort of the top reduction point above the FTE count. So there was some widely discussed ambiguous areas with how this was going to work, and some of those areas were clarified with the loan application that we received. So when we look at the wage reduction rule, the reduction rule is basically that you'll get a reduction to the extent that your average annual salary or your hourly wage during your covered period is greater than 25% of what the same average annual salary or hourly wage was from 1/1 to 3/31. And this clarified 2 things. One of the big ambiguous points was, well, do we look at just total wages earned? Do we look at an annualized salary? Do we look at a monthly salary? How is this 25% reduction rule going to be calculated? And they clarified that you're going to look at an average annual salary for your salaried individuals and an hourly wage rate for your hourly individuals. And then the second question was, when the law came out, it said the most recent completed quarter. That was left ambiguous. Some individuals thought it would be the fourth quarter of 2019. Some thought it would be the first quarter of 2020. We now have that answer. The look back period to compare a wage reduction is going to be 1/1/2020 to 2020. As a reminder, what held from the initial law and the subsequent guidance is that any employee who made more than $100,000 on an annualized basis from 2019 does not need to be considered for the wage reduction rule, meaning if there was an individual who was earning $150,000 and they were reduced down to $100,000, there would be no penalty for that because they annualized made more than $100,000. There was one of the questions we get a lot is regarding the language around any single pay period. So the language that qualifies you for whether or not you make 100,000 is such that if during any single pay period in 2019 an employee has a pay period that annualizes over 100,000, are they included if they say got a bonus on top of their normal pay? And that wasn't clarified, but they did stick to that any single pay period. So it seems to reason that if there was an individual who who earned more than 100,000 because of a bonus in one pay period, that they may not be includable in this calculation. But again, that's not a piece that they clarified. I'm gonna skip over this calculation piece here because we will get into the details on the next slide. But as far as documentation, the Schedule A worksheet, again, as Frank and Dan mentioned, although it's not required to be submitted to the lender, it may be requested by the lender. That's the schedule that will calculate a lot of this information. Next slide, please. Thanks, Chris. So what we'll do is we'll run through the calculation, and this calculation here, this full slide here came directly from the information in the application. We pulled it out and gave an example, and what we'll do is we'll run through two examples, one for a salaried individual and one for an hourly individual, and we'll kind of point out how the calculation works, and and then we'll talk about the safe harbor after that. So in our first column here under the salaried employee, we are assuming that we took an individual who was making $80,000 on their normalized salary of January 1st to March 31st, and during the covered period there was a reduction of $50,000. So basically, whether or not you have a reduction in greater than 25%, you would take the numerical math of this calculation, and in this case, because your salary reduction was greater than 25% on an annualized salary basis, you would proceed on through the calculation. This is a stopgap here. If this was greater than 75%, you don't need to keep going. In step two, we determine whether or not the wage reduction safe harbor is met. And in this case, what you'll do is you'll take a look between February 15th and June 30th, and we're going to get in a little bit more detail on the next couple slides, so I'll skip down. In this case, we're going to assume just that the safe harbor was not met, so you'll need to continue to proceed. You'll continue to proceed through the calculation. So in step three, what we'll be doing is we'll be taking the amount of annualized salary for that individual during the first quarter, and we'll be taking 75% of that and then comparing that against what we paid. In this case, 75% of the 80,000 is 60 grand. We will take from that the 50,000 that we were paying them, which means we reduced their annual salary $10,000 more than what was allowed under the wage reduction rule. And as you go down the tree, you have a decision here as to whether or not they're an hourly or salary employee. In this case, we're a salaried employee. So what we'll do is we'll take that 10,000, we'll divide it by 52 weeks, and then we'll multiply it by 8 weeks to get the wage reduction for that individual during the 8-week period. So again, we took the 10,000 divided by 52, multiplied by 8, and we came up with a wage reduction for this individual of $1,538. The hourly employee is a little bit different in that the way that the calculation works is that you look at the actual hourly rate that you pay them. So if we look at our second column here, our hourly column, what we would do is we would take that hourly rate, and for our purposes, we utilized an individual who was making $15 an hour under normal circumstances. During the covered period, their wage rate was reduced to $10 an hour. So we did not meet the 75% threshold. Again, for step two, we'll assume that we did not restore their wages and the safe harbor was not met. So we move forward to step three. Step 3, what it does is it takes that hourly rate that they were earning of the $15, it multiplies by 0.75, and it compares that against what they were being paid. In this case, there was a $1.25 reduction in excess of that 25% allowance. And here's where it gets interesting, is that the way that the calculation works is that in order to calculate your reduction, you are to take the amount that your reduction that exceeded 25%, and you would multiply that by the number of average hours worked for that employee during the first quarter. So you're not looking to the 8-week covered period to see what your reduction is. You're looking to what that individual worked during the first quarter. What you would do then is so in this case, we have $1.25. That individual worked an average of 30 hours during the first quarter. So we would take that $1.25, we multiply it by 30, and then we multiply it by 8 to get our reduction. Thanks, Chris. Next slide, please. As we've said before, there were some favorable provisions as part of the applications, and one of them is the safe harbors that were introduced. Well, the safe harbors were in the original law. There was a lot of ambiguity around them as to how they would actually be calculated into the final guidance. But the way that they are working in the current iteration of the loan application is such that you'll compare the average annual salary or hourly wage of an individual from 215 to 426 with the same number as of 215. So basically, the gating feature on the safe harbor rule and whether or not you can qualify is, did you have a reduction? If you had a reduction as of from 215, between 215 and 426, if you reduced, you qualify for the potential to correct it via the safe harbor rule. And if you meet the safe harbor rule, any reductions that were calculated as a result of that that would have been calculated as a result of that safe harbor rule do not apply, and you will not have your forgiveness penalized. So if a reduction exists, then you can restore it as of 6/30. So what you'll need to do to qualify for the safe harbor is, if an individual was making 80,000, you got to get them back up to that 80,000 by 6/30. If an individual was making $15 an hour, you got to get them back up to that $15 per hour as of 6/30. And if you do, it appears that there will be no penalty or reduction in forgiveness as a result. And just a couple of insights or thoughts on this. It appears to be a snapshot approach, such that the rule will look at the average annual salary or hourly wage as of 6/30. There is no indication as to how long they need to be on payroll after that date, or how long they need to be, kept at full salary. It also doesn't specifically say that you have to pay them. However, in the documentation requests for how you're going to prove it, it says that you need to provide a payroll report that covers the 6/30 date that shows that they were back up to that wage. So the only other thing we have right now is that we're just recommending that companies be reasonable and consider substance over form. That it could be the case that they take a look a little bit after that and come back on it, and make sure that it's not that an employee was hired for one day at that wage and rate. Next slide, please, Chris. And here what we did was we took the same example that we had previously, and we came back and said, okay, how can we meet the safe harbor? Same fact pattern. We had an individual making 80,000. They were dropped down to 50,000. In our step 2 here, under B, we would enter the average annual salary or hourly wage between February 15th and April 26th. Again, we have that gating feature where there has to be a reduction between February 15th and April 26th in order for you to qualify to meet this safe harbor. And in this case, since we reduced it down to 50, there was a reduction. And as of June 30th, we corrected that reduction, meaning we got them back up to their $80,000 average annualized salary from 1/1 to 3/31. And as a result, our safe harbor is met, and we did not have any penalty here.
Matt, I have a question for you. What if that June 30th is after the 8-week covered period?
Yeah, it's a great question, and it's one that hasn't been clarified yet, right? So the situation exists that if you get your loan on May 15th, right, your covered period extends past June 30th date, and that's just something that we don't have an answer to as of right now. One more point of emphasis here before I pass it on to Chris is such that it appears that the safe harbor is a pretty binary calculation, meaning if you brought them back up to $79,999, you have not met the safe harbor, or $14.99 per hour, you have not met the safe harbor. You have to reach back to the period that they were making prior to prior to COVID. So with that being said, I'll pass it on to Chris to talk about the headcount.
Thank you very much, Matt. Good early or late morning, early afternoon to everybody. As I sit here and I listen to this presentation, the thing that goes through my mind is, I wonder, there's thousands of people on the line listening to this. I'm wondering how many of them could have ever imagined a few months ago that they'd be sitting on a 2-hour-long presentation on SBA loans. I can tell you I'm one of them that would have told you I think you'd be crazy. So I'm going to try to cover these quickly. We've got a ton of questions, which are the things we probably should spend the most amount of time on. But there are, as Matt sort of alluded to, there are two major levers when it comes to a potential reduction of forgiveness in this loan. And the first one that Matt went through was the wage reduction. The second one is a reduction of full-time equivalents of FTEs. In conversations with our clients, we tend to see that this is the one that probably has the most of their attention because they may not have brought back all of their FTEs. So we want to walk through, I mean, we've talked about this a lot and there's a lot of knowledge out there already, but the application did provide us some more clarity. So setting some table stakes. The first thing is, when you think about forgiveness, your forgiveness will be reduced by a ratio of the amount of FTEs you brought back during the covered period compared to one of two periods that are of your choice, whichever one benefits you most. So if we look at our covered period and we say on an average weekly basis, just simple math, we had 50 FTEs. We would then compare that to one of two periods. One period is February 15th through June 30th, 2019. And the other one is January 1st through February 29th, 2020. So let's just say we took the second option of 2020 and we looked at that and we said the average FTEs during that period was 100. What that would mean is that obviously 50 divided by 100 is 50%. We have a 50% reduction of our forgiveness as a result of a reduction of full-time equivalents during the covered period compared to this other period. So one of the things that was important about the new application is that this, while it seems like a relatively benign or simple calculation, it did lend itself to a lot of questions. Number one, how do you actually calculate an FTE? That was undefined in the statute and was undefined in any future, interim final rulings or FAQs. So they gave us, good clarification here. There are two methods. There's a base method and a simplified method. So what we learned is an FTE, as you might have expected, can't exceed 1. So if you have somebody, the first and most important thing that we learned is that an FTE in their mind is a 40-hour week. We had anecdotally seen the SBA and other unrelated situations think that an FTE was a 30-hour week. In this case, they defined it as 40, but you can't be more than one FTE. So if you're a person that works 50 hours a week, you as an FTE status is 1, not 1.25. If you worked less than 40 hours a week, then you're a ratio. So in our scenario, what we said is, okay, somebody who works 40 hours a week, that's 1. Somebody that worked 50 hours a week, that's 1. If you worked 10 hours a week, you were actually 0.3 because that's 0.25 and they want you to round to the nearest 10th. So under the base method, you're 2.3 FTEs in that scenario. You have an alternate method that you can use called the simplified method. And in that case, what they're basically saying is anybody that worked less than 40 hours a week, they're going to be a 0.5. Now, if you think about this, if you don't have a lot of fluctuation in terms of how much people were working in your covered period versus your comparable period, whether you use the base or the simplified may not make a difference. But there is actually some scenarios where it could make a difference for you. So you really want to actually consider going through each method and seeing which one works the most or works the best for you. So for example, if you actually have a lot of hourly employees and during your covered period, the hourly employees worked a little bit less than they did in your comparable period, you actually might want to use the simplified method, because in our scenario, look at a base method versus a simplified method. We actually got a little bit of benefit under the simplified method in terms of number of FTEs. Now, if you're comparing that to another method, to another period, you have to use the same methodology. So you either use the base or the simplified. So you want to probably toggle between the both to see if you have a benefit. The next piece that we got that was probably very important was we got more clarity on exclusions. So what we knew going into this was if you had laid somebody off and then you offered them a job during the covered period and they refused to come back, whether they got another job or for whatever reason refused to come back, FAQ 40 told us you can exclude them as a reduction of FTEs. So you don't have to worry about that. But what the new application gave us was actually 3 more options. 1, you can fire somebody for cause. 2, if somebody voluntarily resigns, or 3, if they voluntarily request a reduction of hours. In all of those cases, you can ignore that reduction of FTEs for the purpose of this calculation. And that's pretty important.
Chris, the questions come in on this topic. Is there any sense of is there any requirement that when you replace the employee, they be at the same wage, or can you replace someone with a lower wage and still get an FTE benefit?
Well, I think you can replace them with a lower wage, still get an FTE benefit, but I think you potentially would have a reduction. Let me think about that. I guess you wouldn't get a reduction you wouldn't get a salary reduction.
Right, you wouldn't have the wage reduction because you only look at the people during the covered period.
You only look at the people during the covered period. So you could replace these people with a lower wage and get the FTE benefit. I mean, the only downside is in theory, you're spending less money.
Right.
So if you're spending less money, you have less forgivable expenses. But yeah, I mean, you could replace them with somebody at a lower wage for sure. I'd say there's nothing that would stop you from doing it. So the next piece I wanted to cover is the safe harbor rule. And similar to Matt's slides, there's, in my opinion, a somewhat strange rule that was put into the law in the original CARES Act. We candidly thought that it would either be ignored or maybe it was some type of a drafting error, but it has emerged again in the updated application. So basically, what's happening here, similar to the wage reduction rules, they are offering a way to cure any FTE reductions. So what you would do is you would take a look at your total FTEs on an average weekly basis from 215 to 426, and you would compare that to 215. And if you have a reduction, so basically if you let anybody go between 215 and 426, you have an opportunity to qualify for the safe harbor. And basically what they're saying is if that reduction is restored, whatever that reduction is, if it's restored by June 30th, then you get to basically ignore any reduction in FTEs that you had during the covered period. So similar to the wage reduction approach, it's a snapshot approach. So basically they're looking at this as of a point in time on June 30th. We expect that they'd need to have at least a single payment during the pay period that covers that period, that date. But there's no indication whatsoever about how long you have to keep these folks. So in theory, does it mean that you could hire somebody on June 29th and terminate them on July 1st and get availed of the FTE reduction rules? Right now, I guess technically the answer is yes, but we always say you have to be careful about acting reasonably and in the ordinary course. But I want to walk through an example of this just so that people can see it and understand the illustration. So if I'm a borrower that has a $250,000 of eligible expenses during my covered period, and my my average weekly FTEs during the reference period, and that was kind of like that one of 2 periods prior to the covered period they get to choose, was 300. But during my covered period, I only had 30. I had a 90% reduction in FTEs. So what that means, going down to the analysis, is my $250,000 of expenses that are potentially subject to forgiveness would be limited to 25 because 90% of my FTEs were reduced. Now going back up to the facts, on 215, I had 35 FTEs, and between 215 and 426, we averaged 29. So we had a layoff in that period. We actually had a reduction of 6. If we restore back to 35 FTEs as of June 30th, then the forgiveness amount is restored to the full 250. And we completely ignore our $225,000 reduction in forgiveness. The best way I can describe this is that it is disproportionate, right? It doesn't make a lot of logical sense, but this is what's written, and it was reiterated in the application. So it is clear that there's intention that the safe harbor concept is going to exist and it's going to be employed. This is mechanically how it works. So there are many companies out there that will benefit from this if it stays intact and there are no further FAQs or clarifications on how the mechanics will work. But this is important to understand. Here, I'm not going to go through this, but it's good for you guys to have it. This is literally just the step-by-step process of how it works in the application. You can basically, look at this at your leisure. So running through, I think the piece that we want to just kind of run through with everybody as they start thinking about forgiveness is just a summary of the dates. And believe it or not, as you've gone through this webinar, you may have realized there are many dates that you have to think about. What are the dates that you use to determine the loan application? What is your covered period? What is the average weekly FTEs that you're looking at when you have a covered period, and what are you comparing it to? So you can see there's 3 dates in that section for FTE reductions alone. For salary and wage reductions, there are 2 sets of dates that you have to consider. One is your covered period, one is your covered period dates, and the other is your comparable date, which in that case is going to be 1/1 to 3/31. Then you get into dates for FTE safe harbors and salary reduction safe harbors. That's where we introduce the 215 to 426 date range for both of those scenarios. So, what it really means is that as you start thinking about forgiveness and you start trying to plan it out, you have to really get a lot of data. What we're seeing is a lot of payroll companies are starting to put together reports where at a click of a button, you're going to be able to get this specific data out of your report. So that should be helpful for people. But I think looking at this now and understanding what these FTE counts are indicating and what these salary reduction counts are indicating within these periods is going to be really important because it could have a material impact on your forgiveness. Next piece is just documentation requirements, and then we'll get to Q&A. For those of you who are working with companies that are audited or work for companies that are audited by external accountants, this is going to look very familiar. It feels a lot like what you would do when you're validating data in an audit. So we expect, or they've indicated that you should have things like bank account statements and third-party provider reports ready. Those are like your payroll reports. You may want to have tax forms ready, like 941's quarterly wage reporting, so that you can support your state and local forgivable expenses. And of course, receipts, canceled checks to cover payroll costs. When it comes to non-payroll costs, one of the keys that was mentioned is that some of these costs, most of these costs, for example, when it comes to mortgage interest payments, you need to have been engaged in that contract in February in order for it to count as a forgivable expense in the covered period. So you're going to want to be able to show lease statements and contracts that prove that you actually were in contract at that point in time. Lease agreements, copies of invoices, receipts, canceled checks, and bank accounts to verify that those expenses were in fact paid during the covered period, or in some cases incurred during the covered period and paid during a subsequent period. So, having this information ready and also being able to have it at the ready should the SBA, decide to inspect your forgiveness application or a bank decide to ask for additional information. Obviously for those who have loans that are above $2 million, there may be a higher level of scrutiny than the ones that are below $2 million, but we're just not 100% sure what they're going to do or how ambitious the SBA is going to be when it comes to those things. Keeping your documents for 6 years or from 6 years after the date of the loan is forgiven or repaid in full. So that's an indication that the quote unquote statute may be open for a substantial amount of time after these proceeds are spent. And obviously keeping all of your documentation at the ready. I think one of the things that's important that was mentioned before is there are several, while many of these schedules are required, not all of them are actually required to be submitted with the application for forgiveness. As an example, the Schedule A worksheet, you have to have that ready for inspection, but it's technically not required to be submitted when you submit the application. we expect that the banks are going to come up with some type of a, I'll call it an audit or verification process whereby they're probably going to ask for this when you ask for forgiveness. So the last piece, we put into the presentation the application itself in case there's anything you want to reference or look at. The one thing I would say you might want to spend a minute looking at is the certifications. They haven't changed substantially from things that we had seen on the front end of this when you were applying for the loan. But I think what's just important is just remembering what you're certifying to, and there are, in theory, risks of criminal action if you do not act in good faith, or you intentionally, quote unquote, defraud the SBA in some way, shape, or form. So I don't think that there's anything here that should give anybody particular pause in that, something widely different from what they signed on for when they signed on for this loan. But paying good attention to this is good practice. So with that, I'll run through these pieces. And I think we're ready, guys, to get to some questions. I know there's a ton of them that are building up.
Yes.
Yes, I'll lead the questions for you guys to answer here. We got literally hundreds of questions. So the first one goes to legislation, and what's the latest thinking on, will this program be changed, and if so, how?
Yeah, I think the one thing that we've seen there is the HEROES Act was introduced by the House about a week or so ago. It passed the House. It was not a bipartisan bill. It was largely pushed by the Democratic side. And that introduced some material changes to the PPP. One of them was extending the cover period to 24 months. The other one was getting rid of the 75% rule altogether.
24 weeks, Chris.
I'm sorry, did I say 24 months? I apologize, 24 weeks. It's a big deal. The other one was getting rid of the 75% rule altogether, and then also talking about extending the repayment terms. So in the original statute, it actually said that the loans could be up to 10-year repayment terms, and for whatever reason, 2 years was selected. Some think that that's a little bit of a punitive action, and there's no reason. You don't need a legislative fix to extend that term. The extension of the covered period would be a material issue that could benefit a lot of companies, especially companies that didn't intend to spend all the money during the covered period, but certainly could be harmful to companies that had their covered period and spent a lot of money that they may not have necessarily wanted to spend if they knew they had more time. So that legislation isn't necessarily going anywhere right now, but our understanding is that there is a new piece of legislation that does have bipartisan support that carves those specific changes out of the HEROES Act, which has an enormous amount of other stimulus in it. That's going to be controversial and potentially could be passed. We don't know if it's going to be passed, but there's stuff floating around on the internet that's basically indicating that there may be a vote as early as next week. So I would say stay tuned on that.
Great, thank you. Next questions come in is, when does the form get submitted? Is it after the 8 weeks is up, and does it go to the bank or to the lender?
It goes to the lender. The place that gave you the money is the one that's going to give your forgiveness. You need to go to the 8-week period because you need that last spend. So you have to produce all the documents that Chris mentioned. So you would have to have the payroll records and all that information. As I mentioned before, your first payment is due sometime in October if you got the loan in April. So you want to at least and the bank needs 60 days. So as I mentioned, we're looking at, you want to get the information to the bank, the lender, whoever your bank, it's usually a bank. Most of the banks are the lenders, by August 1st. That'll give them 60 days to process it and get you the amount of forgiveness that you have.
Great, thanks. And I'll put my tax hat on here. As you mentioned during your presentation, Frank, there's a tension between repaying the loan and maximizing that employer payroll tax deferral. And so the sooner you'll get your forgiveness application in, the less you'll have to you can get your forgiveness out of the way, so you won't have to start repaying that self-amortizing loan. On the other hand, once you get a forgiveness decision, it prohibits your ability to continue the employer payroll tax deferral to the end of the year. So there is that tension, and you just need to decide which is more valuable for each individual person. Next question that came in is about a bunch of questions about bonuses. Can people pay bonuses during the covered period, and are there any limitations?
I mean, I think the way I would probably answer that is there's nothing at all that specifically prohibits bonuses from being paid. In fact, there are scenarios where it's specifically indicated that a bonus is subject to the payroll calculation. My view is that you can absolutely do bonuses. I think if you have a history of doing bonuses, you certainly could provide or issue bonuses to employees during the covered period. I wouldn't do anything outside of the ordinary course. I think that's kind of the big piece of the puzzle that I think our borrowers need to understand is don't do anything that you wouldn't have normally done. I also would not in any way attach the bonus to anything outside of the covered period. So for example, don't say, hey, this is a bonus for this is an advanced bonus for your Q4 commissions or something like that. It really needs to be free and clear when you're giving it to them. It's something that they've earned, but I don't have an issue with it.
Okay, and a related question to that's come in is, should I segregate my PPP funds in an account or should I mix it in with my operating account?
I would think no, you can mix it in with your operating account, because what you're going to be supplying to the lender to get forgiveness is just is documentation of what you spent. It'll be canceled checks, it'll be payroll returns, it'll be leases, it'll be payments for the utilities and rent. So you don't need to segregate it out. It could actually cause more headache for you internally to separate the amounts and then have to pull it from the PPP loan to pay amounts that are over and above the calculated amount in the forgiveness. So I would say don't keep it separate, just commingle it.
Okay, the next question here is about rent and the paid or accrued question. It says, if we pay rent that's past due, so I guess it accrued before the 8-week period, will that be forgiven?
Yeah, so in theory, based on the verbiage that's used in this loan forgiveness application, you would be able to include rent payments that you paid during the period, and if that includes the previous month's rent that you deferred because you didn't have the wherewithal to make that payment due to cash constraints, then in theory it is included in here, and it seems like that language was intentional. And that could be subject to change based on further FAQs or interim final rulings. But before this application came out late last week, we were hearing from some of the SBA sources that the loan application itself was going to be quote unquote very forgivable. So it may have been an intentional way for them to include some additional expenses and take it easy on the borrowers.
Great, thanks. Next question says, I am a partner in or member of LLC or partner in a partnership. Does my draw count toward the 75% of payroll costs?
I believe for partners, you're using your 2019 K1. So the 2020 information would not matter. You're going to only base it on the 2019. So if you're taking a bigger draw in 2020, you're still reverting back to the 2019 K1 that you were issued.
Right, but for the amount the amount they are entitled to pay during the covered period, does that count as payroll? We think it's in the definition of payroll cost. I don't mean to, sorry,
Okay.
maybe it's
Yeah,
the way I'm
sorry.
phrasing it. Yeah, it's a simple question. I didn't mean to trick you. It wasn't.
You did. You tricked me.
Sorry about that. It's in the definition of payroll costs, and so it would be included as for the
Okay.
in the 75% piece.
Yeah, it's an allowable cost.
Right.
I got you. Yeah. So the next question relates to employees who resigned. What happens to the headcount for people who quit on their own because they're afraid of coming back to work because of COVID-19? How does that get accounted for in the FTE calculation?
Yeah, this was a principal concern of many when the original rules regarding the FTE reduction came out, and the application actually provided a couple of additional exceptions or exclusions for this that were pretty favorable. So if there is an FTE reduction as a result of an employee who was fired for cause, an employee who voluntarily resigned, an employee who voluntarily requested a reduction in their hours, or an employee who is laid off and refuses to come back for whatever reason, they found another job or they are making more on unemployment, those four pieces are scoped in as non-penalizing to the borrower, meaning you'll have a potential to take an exclusion for those provided that you didn't replace that person.
Great, thanks, Matt. Next question came in from Kenneth. He says if we partially return PPP money, so our total loan is now less than 2 million, will we still be subject to the review procedure for the loans over $2 million?
Well, I guess the question I would have would be, when did you partially return the money? If you returned the money on the onset, I think that technically would have allowed you to reduce your loan. Your loan would have actually been reduced because that would have reduced the original principal amount of the loan. But if you're talking about returning the money at the end of the cover period because it was unused, that wouldn't have an impact on your original loan amount.
Next question, if payroll is bi-monthly, do you have to prorate salaries to equate to an 8-week period?
So the bi-monthly payroll would be the pay date that you disperse the funds. So
Right,
for
paid or
instance, if you
incurred.
paid April 20th was your start date when you got the funds, and your first payroll is May 1st, so you pay May 1st and then May 15th or May 16th. You'll get May 1st, May 16th, June 1st, June 16th. The June 16th will be outside your 8-week period. But as we talked about earlier, it's incurred during your period, so you'll be able to get almost all of that the half a month as part of your payroll. So that would be included. So you probably, in essence, get 4 payments of payroll, which would cover 2 months.
Here's another question about compensation. It says we pay our bonuses each January. Do these bonuses count towards the 100,000 annualized maximum? Instructions do not specifically say bonus.
Well, I think the issue with the wording, I think Matt kind of touched on this a bit, is in terms of the 100K cap for the purpose of like a wage reduction, it's any pay period in which you've exceeded $100,000 extrapolated annually. So in theory, if somebody gets a bonus in December, they likely will have had, I think, a week's pay period extrapolated is what, 1923 or something like that. They likely would have exceeded 1923 in that pay period and could be excluded from the wage reduction rule. Is that what that question was asking about, wage reduction, or?
Yeah, it gets to both. It was too generic.
Yeah.
Next question is about rentals. 2 questions. 1, self-rentals. Does rentals count to a related party entity? Do they count? And 2, what costs are included? If I have a triple net lease, or are taxes included, et cetera, common area maintenance?
Well, I'll take this one. Rent to yourself, your business, I would make sure it's evidenced by a lease. You need to have a lease because it has to have begun before February 15th. And if the lease calls for, whatever the lease calls for is rent, you would include that. So if it includes the utilities, it includes real estate taxes, CAM, it's part of your rent expense. So I would think that would all be included as rent.
Great, and yeah, that's what I usually tell people too. Usually in most lease agreements, the definition of rent includes additional items. They call it additional rent, and it includes common area maintenance, taxes, and any kind of expense that the tenant pays. Next one is, does interest paid during the covered period include a line of credit, like a working capital line of credit? Is that a permissible interest expense? I'll cover that
I'll
one.
take that one. Yeah, I would say yes.
Yes.
Sorry,
Okay.
wasn't sure who was taking it. Yeah, I think our view is yes, right? I think they use the parlance mortgage, which is technically the correct parlance when it comes to the debt instruments that they're talking about as being subject to forgiveness. But I think a lot of people hear the word mortgage and they think about something that's like a house, right? But we think that anything that's covered, any line or debt instrument that's covered under a UCC-1 would qualify as subject to forgiveness.
Great, thanks. Next question is about what's included in payroll costs. It says, is the employer's portion of Social Security and Medicare taxes, so federal taxes, are they included in payroll costs?
No.
The employer's portion of no.
Strictly compensation. Employee portion of payroll taxes are built into their comp, so that would be includable, right? But not employer.
And how about auto leases or rented cars and auto leases? Are they covered under the overhead expenses?
Yeah, so this
Based on,
one was, go ahead, Frank.
no, take it.
Yeah, so this one was another one that was very ambiguous, and the SBA has since clarified that the rent includes both real and personal property. So to the extent that the company is leasing vehicles, that would fall under that personal property. And the SBA actually used lease payments on a vehicle as an example of something that would be includable in the third IFR when they were talking about Schedule C individuals. So we think yes.
Okay, next question is something, Chris, you touched on. It talks about the FTE count. The way you calculate FTEs changed. It looks like it's 40 hours a week now. Most people thought it was 30 based on IRS guidance and that SBA information that was seen online. Any thoughts, or is this correct?
Yeah, I mean, at this point in time, it's a 40-hour work week. I mean, that's how they're defining it for the purpose of this loan, at least. Can't go over 1. So if you're working 50 hours, you're still 1 FTE. If you're working 30 hours, you're going to be 0.8, because that would be 30 out of over 40 is 0.75, rounded to the nearest 10th.
Right.
And
So
then one thing you got to think about too is when you go back to one of the measuring dates, you're using the same 40 hours for that date. So if you use 30 back then, you use 30 now, it's all the same. They're just decided to define what the 40 was. So it's still, as long as you're consistent, you should be okay.
Yeah, it's
Right.
a great point, Frank. I mean, 30, if you have people that are working, because one of the questions we've had is, hey, our folks work a 30 to 35-hour work week. That's what we consider full time. That's fine. This calculation won't harm you because it's an apples to apples calculation. You're going to use 35 during your cover. You're going to use 40 during your cover period. You're going to use 40 during your alternate period.
Next question is, goes to the Pater and Kurt issue. Can employer make contributions for a retirement plan for a prior period, but that are now due during the covered period?
I would say yes, you could do it. I would, if you're making the full year 2019 contribution and you're paying it, I would pay it during the 8 weeks, and I would only count 2 months worth. I wouldn't take the whole year as the deduction, because in essence you're really covering the employee's annual compensation when you paid it. So I would limit that to 8 weeks. You guys agree?
Yeah, I do. I think the limitation is reasonable because they intended it to be an 8-week period. Hopefully they extend it. But there is room for different positions here, given they haven't imposed any kind of limitation on prior expenses. They only have to pay it. Theoretically, you could have an expense from 2015 that you happen to pay now, and that would be covered. But I don't think most people would think the law goes that far.
Yeah, I think you're right. I mean, I think the problem is there's nothing out there that would confirm that, Frank, that view is right or wrong. I think that view is definitely pragmatic, and it's probably thinking in the ordinary course, right? Like, it wouldn't make sense to jam the entire year in. But I'm sure there may be some diversity in opinion on it.
Mm-hmm. Next one, this is an interesting question, and I think fairly straightforward. Can the borrower hire additional employees during the covered period and include their wages in order to receive forgiveness? So not a reduction, but an increase in employees.
Yeah.
There's nothing to say that you can't have more employees than you had before. So if you get 100%, if they're actually are doing a function in the business, then that makes perfect sense. The one thing you have to realize, if you're paying somebody just so you get forgiveness, and you don't have all the FTEs, you still may have a reduction in the forgiveness amount, which in essence would be if I hired 5 people and paid them $100,000, but only 20% is going to get 80% is going to get forgiven. That means I got $80,000 forgiven, but 20,000 comes out of my pocket because they weren't generating me revenue. So I'm going to be out that money. So unless they're actually performing a function, it doesn't make sense to do that. But it can be done.
I think increasing your headcount, there's certainly not a problem to increasing your headcount during the covered period. I don't see an issue there, and certainly those costs would be theoretically subject to forgiveness as well. The one piece I'd add to Frank's point, though, which I think is an important point to make, is make sure it's a legitimate, like they're actually performing a function, and I think the the question that we've had a few times is like, well, hey, what's to stop me from hiring my wife, or what's to stop me from hiring my nephew during this covered period and getting more forgiveness? That's the stuff you want to try to stay away from. You know, if you're going to hire more people, that's totally permissible. But, you know, just make sure you're staying away from anything that might look like a related party type of a hire.
And that's the kind of situation too that will show up on that Schedule A worksheet, which is not provided, but it does ask for social security numbers.
Yep.
So they'll have to be put on that sheet. So when the SBA comes to audit you, you have to provide that upon request.
Correct.
We got a lot of questions here about the snapshot approach. And so, you know, some people want to hire someone back for a day, they want to restore their wages for a day. And sort of the questions sort of relate to how long, are there any limitations on what I can do here other than being reasonable?
I've struggled with this. I've struggled with the safe harbor rules ever since we've seen them. I mean, they don't make a lot of sense to me. But technically, there is no guidance that says you couldn't hire somebody again for the day and then terminate them the next day. And keep in mind, for many people, this June 30th date actually takes place after their covered period. It doesn't even happen in their covered period. So even that's a little bit funky when you think about it. So, you know, I'd be interested to hear Frank or Matt's thoughts, but the only thing I could say is I would try not to do anything that looks extreme or that just doesn't kind of pass the smell test. You know, but yeah, there's not a lot more guidance than what we've already provided.
Right. And I would just say when it comes to providing the proof that you restored it, what they're going to be looking for is they're going to be looking for that pay period to show that you restored them back. So if you restored them back for one day on June 30th, you're going to provide a payroll report that has whatever your period is, weekly, biweekly. You're going to provide a payroll report that has them making 1 day's worth of wages over a 2-week period. So that may raise some red flags as far as whether or not they were truly restored as of June 30th.
Yeah, what I tell people, go ahead, sorry.
But it does, you know, one thing, you know, obviously we're talking about the kind of the extremes of somebody making a decision to do something extreme to try to get it. But going to just the, you know, a normal situation, it really is important to know if you had a reduction from this February 15th to 4/26 date. We have some clients that could have a marginal increase in FTEs to restore that reduction and be able to ignore massive decreases in FTEs that they actually had during their covered period. So it is important.
It is. And the thing that I'll say is that, and I've said this before, this is not the company's money. This is the government handing money to the company to pay payroll and some overhead costs to keep the doors open. So when you're looking at trying to get the most forgiveness, this is different than a tax law where a tax law is issued and you're trying to save taxes and you actually earn money to keep it in your pocket. This is where the government handed the company some money. So I would refrain from trying to manipulate this facts and circumstances so that you get the most forgiven. And as Chris said a couple times, and Matt, normal course of business, operate as if you're running your business normally, and you should be okay, because at some point in time there is a chance, and it's not just the 2 million and over that the SBA could look at. They will probably come in and test check some of the other businesses. And as you saw with Shake Shack giving back the money, the public shamed and the government shamed Shake Shack to give that money back, when I really think they should have kept it. So we don't know if they're going to try to make examples of some smaller businesses to say, here's what happens. And there's some significant, you know, fines involved. So I would, if it was my business, I would do just what I'm supposed to do. I'd try to do in a normal course of business and not try to take advantage of situations.
Yeah, what I tell people in that situation is you should keep them, employ them for the minimum amount of time you would feel comfortable explaining to an inspector general when you're sitting across the conference room table from him when he's auditing you, and your lawyer's sitting next to you and you're being audited under the PPP program. So that's the amount of time you should keep them, because that's really what you're going to have to say and be comfortable saying it.
Yep.
Right.
I took out the dimly lit portion of it. I thought it was too much imagery, but sometimes I go there. Next question is, I moved my office location a few streets away in February. And so I have a new lease now. Is the rent included on my new lease? Is that covered?
Not unless it was in place prior to February 15th.
Yep.
Right, yeah, it's an unfortunate circumstance that they moved, but unfortunately, right, the rules don't allow for that.
Yeah, and that also is with respect to other non-payroll costs too. Utilities, anything that wasn't in place as of February 15th is not going to count.
Next question is a question from someone who's a cash basis taxpayer, and they want to know if they can pay their rent in advance during the covered period to get maximum loan forgiveness.
Well, I mean, it's paid or incurred, right?
Right.
But no prepayments. You can't do prepayments, and that's,
Yeah.
I think,
Right.
what would likely shut it out.
Right.
Next to the wage reduction calculation, is a bonus included in the wage reduction calculation? These are performance bonuses, not guaranteed bonuses.
Wages are wages. So whether you got paid a standard hourly rate, a standard, salary, or whether it was a salary and a bonus, I think they're just looking at your wages during the 8-week period and comparing it.
We got a couple questions here about 401ks and profit sharing. Are they included in payroll costs? And if so, are they subject to the cap?
Well, I think it depends. It depends on what we're talking about, right? A 401k versus a profit sharing. A 401k, payments, employer payments to a 401k, not employee contributions, are definitely going to be subject to the calculation, and they're over and above the 100k cap. Profit sharing, I mean, I think it gets a little bit more ambiguous once you get outside of the traditional 401k benefit plans. I don't know if Frank or Matt, you had a point of view on that, but I think it depends on what the plan is. Is it a qualified plan? Is it not a qualified plan? I think that'd be case by case for me.
Mhm. I agree with Chris.
Agreed.
Still getting some questions about the certification that the loan was necessary. Is that still an issue given that the safe harbor deadline is passed?
Well, I mean, I think, what we know is they created a line of demarcation at a $2 million loan amount. So if you're under $2 million, this is a non-issue. You're going to be presumed to have been eligible. If you're over $2 million, you need to, make sure that you've got your documentation related to what made you believe at the time that you applied for the loan that you had a need, that you would have met the standard, which was obviously a very, very broad and ambiguous standard. The fact that the repayment date has passed, it's sort of interesting because when they came out with some new FAQs, it seemed as though they subtly took off the table criminal prosecution related to not being eligible, and kind of said, if we look at this and deem that you weren't eligible, you have to repay the loan. And I think that what that means is that there wasn't a lot of benefit to repaying the loan by the kind of new due date that they had put out there. So I think at this point in time, I think you just have to presume that you are eligible. You have to have your documentation that supports that, and then just be ready to supply it if it's required.
Yeah. And I did see something pop up about the Shake Shack issue because they were public, and the issue that really happened with Shake Shack and with any other company was they have access to capital elsewhere. And if you look at a lot of businesses, if you have a line of credit that you can tap, the question becomes, do you have access to capital elsewhere that you need, and you needed this money? So I don't look at Shake Shack being any different than, even though it's public, any other company that's operating that has access to capital, or the owner is a very wealthy owner that's worth $800 million, and he can put money into the business. So I think that there's a question there. And I think the thing that scares me is because Shake Shack did give the money back and they had access to capital, what happens to that law firm that has the owners are worth hundreds of millions of dollars? Should they be giving the money back because they have access to their own capital? So that's
Well, I think
that's the part that scares me here.
And I know Mnuchin went after public companies for a while, and I think you know, there was a lot of negative public sentiment to them to getting money, and I think, you know, not really providing an opinion one way or the other whether or not Shake Shack should have returned it. I think the one thing that I would say is that you can't assume that just because a company is public that they have access to sufficient capital, right? The public companies can't necessarily snap a finger and raise $40 million because they're public. There has to be public interest to invest in that company. So you know, that was a thing that I think it became very controversial, but I don't think that anything that was said in those FAQs really specifically said you can't take this money if you're a public company. I think it becomes a question of how easy it is for that company that in their mind to be able to raise capital.
Right.
All right, let's move on.
Yep.
Okay, next question is about the exclusion from the excuse me, for wage reduction calculation for employees making over 100,000, and they reference that number you mentioned, Chris, the 1923. I think maybe just clarify that was for a weekly pay as a, you know, as opposed to biweekly. That bonus, if you had a bonus of 1923 or comp.
Yes.
Oh, I was asking you to clarify it. I'm sorry. I'll do. Yeah, what Chris
Go
was
ahead,
saying is
He
if,
said yes.
if in any one pay period an employee made in their weekly paid weekly, they made more than $1,923, they will be excluded from the wage reduction calculation. If it's bi-weekly, it's twice that, and maybe I can't do the math that quickly in my head. It's around 3846.
Yeah.
So if it's bi-weekly, so if someone's normal pay is 2,000 and they got a $2,000 bonus last year, then they would make over 100,000 on an annualized basis in any single pay period, and they would be out of the, you do not need to consider them for the wage reduction calculation.
Yeah, it's another one that seems disproportionate, but yeah, that's right.
Right. Next one's for the calculation of the average weekly number of FTEs. What if someone was on unpaid leave for all or part of that period? So I guess they have no hours is the point. They have 0 hours.
Yeah, I mean, I think this comes back to the question. We get a lot of questions around furlough, which I think is kind of what you're talking about, Dan, right? I mean, unpaid leave. So the question is, if you're on unpaid leave or if you're furloughed, are you still an employee versus are you laid off? If you're laid off, in theory, you're getting no benefits from the company. You have severed employment. If you're furloughed, in theory, you're still an employee of the company. You're just not getting paid. And I think the way that we're looking at this right now is, if you're furloughed or on unpaid leave, as you call it, you are still an FTE, so you're not taking an FTE hit. However, you're going to take a wage reduction hit as a result of the fact that you were not paying that person during the covered period, and they presumably had wages prior to the covered period.
Yeah, that's interesting. Some people take a different view of that, because I had a client just yesterday telling me that they don't think furlough means anything. Their HR people tell them the furlough is a government concept only and doesn't apply in the private sector, and that you must have laid them off. That was just their HR's interpretation.
Yeah, I mean, it's
We
tough.
hear a lot of this.
Yeah, I'm not an attorney, but you know, and so I'm even doing reading on the same thing. I mean, the only line of demarcation I've really seen between a furloughed and a laid off employee is that the concept that furloughed employees would still be eligible and receiving benefits from the company.
Right.
They're just not getting paid. But you know, that one's a tough one.
Yeah, and just to add on to this question, because I know I've seen quite a few in here about, you know, when we calculate the average FTE, we've got an employee who works a different amount every week. They work 10 hours one week, they work 20 the next, they work 25 after that. The way that the average FTE calculation looks like it's going to end up working is that you would look at each week and calculate an average over the covered period, which would get you to that average FTE for that individual over your covered period.
Yeah, another question came up, which is interesting. I actually had this question a couple days ago. An Army reservist, and the person can't come back to work because they're serving. Is there any exception for that? And I'll just throw what I had said the other day was, it's kind of like this is the round hole square peg problem, because they didn't. It's not voluntary. It's not someone who voluntarily didn't return to work. I said I think maybe the answer is you say that they voluntarily joined the reserves, and that requires them to be away, so they voluntarily reduce their hours. It seems like there has to be a relief here for in this situation. The question is, how do you get there?
Well, couldn't you offer them a job?
No, they are employed. It's just someone who's in the reserves and they have to go serve the military.
Oh.
Yeah. So
I
they
agree
get-
with your reasoning, Dan. That makes sense.
Yeah, that it's voluntary, even though.
Voluntary,
Agreed.
right?
Yep, voluntary, yep.
Next one, group dental insurance premiums. Is that an eligible payroll cost? I've said in the past, I think it is, because health insurance is determined broadly. It covers vision, dental, at least
Yep.
for tax purposes. So,
I would
Right.
agree.
yeah, okay, good. Good to get confirmation in a public setting that we all agree on that.
Right.
They said the rehire rule. Do you have to rehire the same employee, or can you hire different people, and how does that work?
I don't think there's any requirement that it's the same employees. I think you have to make a determination as to what your decrease in employee headcount was during that period, and you have to demonstrate that you restored that during the covered period. Well, as of June 30th.
Right. And just keep in mind, if an individual is employed at any point during the covered period, that automatically includes them in the salary reduction piece. So if they're only employed for the first week of the covered period, then you have your, it kicks in for the salary. But other than that, no.
Here's a question I'm fairly certain you guys have never had before, so I'll throw you a curveball here. What about two questions about rent? One, would a storage unit rent count as rent for forgiveness? So they're paying rent under a lease on a storage unit.
I think so.
I think so.
I think so
storage
too,
unit
yeah.
Real
Yeah.
property, right?
I
That's
would
real
think
property.
that's okay.
Equipment leases, do they count as an expense if you have an equipment lease?
The interim final rule that came out on Schedule C's talked about, the first place I saw it talked about vehicles as being rent, so leases on vehicles, but it didn't necessarily talk about equipment, office equipment. So, and it also talked about utilities, transportation costs being gas for a vehicle as well. So, that's one that I'm not sure about on that, whether you can. I don't think you can. My position would be no, but it would be keep track of it anyway and keep it on the side. And then when the calculations get done, hopefully there'll be more clarification at that point in time. Or if you're going to add it, document on the form an addendum what you added in to cover to the rent. If you guys agree or disagree on that?
I agree with that.
Next question is, will there be any exposure evaluation of the borrower after the 8-week period for changes in pay or FTE changes?
Well, I mean, they indicate that you have to keep the documentation available for 6 years. So I think, you're going to go through a process of forgiveness where the bank is going to evaluate your application. And at that point in time, the loan will be forgiven or not be forgiven. The bank will come to a conclusion. I don't know that the act of forgiving the loan is the absolute conclusion of any potential exposure for future audits or reviews. So I think you have to keep the documentation for the 6 years. I mean, pragmatically speaking, I'm sure as more time goes by, there'll be less and less interest to look at companies. There'll probably be a lot of interest in the first year, but after that, it'll probably drop off. But I think you got to hang on to your documentation for a while.
Okay, now last question I'll throw out there. I know we're running out of time here. It says, what if I can't get employees to come back to work and I hire my wife to step in?
Yeah, I mean, I think you got to be careful with that. I think you have to be able to clearly, show that they wouldn't come back. And I think you probably have to clearly show that your wife really performed a function, and that she wasn't just on the books because, you wanted to try to get forgiveness. I think you're walking a tight wire there. So you got to be real careful with it.
Right. I believe the FAQ that came out was that you need to make a written offer to employees to come back. So you'd have to show and document that you offered to certain employees an offer and they didn't come back. And then, as Chris said, your wife is capable of doing whatever function in the business that is needed.
Right, and save all the emails of the work she does during during the period.
Mhm.
You can show she showed up at the office and did some work.
Yeah, but when you fire her after the 8-week period, she's not going to be happy.
Right. The next question I think is probably the most important one for Allison is, can I get CPE for attending this webinar?
Sorry.
We are not giving CPE at this time, but we will send out an email with all of the PowerPoint presentation and the webinar recording to everyone that was registered.
Is that where we say attendance is its own reward? Is that what?
Yes, exactly.
I think that's Allison. You want to close us out here? Or?
Yep. Thanks everyone for hopping on. We will be sending out that follow-up email later this afternoon with the PowerPoint presentation and the webinar recording. If you have any other questions, please feel free to send an email to either me or on the registration there and whatever other contact information you have, and we will try to get back to you. Thank you.
Thank you,
Thanks,
everybody.
everybody.
Everyone, have a good one.